Hey everybody, welcome to the show. Today we're going to be talking about what investors need to know about this housing shortage that we're facing across the United States right now, and the demand for housing, the 25% increase in prices, all of that. We'll be talking about on today's live show. We're going to start in a few minutes here. I'd like to let those alerts go out from YouTube and Twitter and Facebook and everything so that people get alerted before we dive into the show, and that way everyone gets a chance to jump on and join us. So let me know where you're joining us from here in the chat. Hopefully we've got the chat overlay up here on the screen. I think we do. Hey there, hey there, hey there. Hey there, hey there. Today I had to get a for a life insurance policy that we're doing. Oh my gosh, we had to do like blood tests and stress tests and everything tests. It's a lot of fun. Blood drawn blood. Tons of fun. You guys ever have one of those? Not my funnest time. Just gonna pull up my notes here. Okay. See if I can get the chat pulled out here. Okay, so we're going to start here in just a few moments, just making sure all of the alerts go out for everyone. Stephen, good to see you. Johnny is here from Washington State. Pop out chat. Hey, Eric, you're from Boston. Hello from Cali. Vince, good to see you. Hey, Hashim is here. Stephanie. De La Shell Webb is here. Good to see you guys. Michael Olson from Wisconsin. Will from West Lafayette, Indiana. I once spent a night in West Lafayette, Indiana. My girlfriend at the time, we were driving back from Chicago, and we got a flat tire. We stayed not too far from a, I think, was it a Johnny Rockets? Do you know what I'm talking about, Will? I think it was a Johnny Rockets. It was like nearby. That was and we had stayed at like a little hotel because our car broke down. And then we went. I think we had dinner at a Johnny Rockets. Had one of their patty melts, I think, which are delicious. Hard to beat those, huh? Okay, all right. Hey, Sherry B from Fort Worth. All right. Welcome into the Real Estate Investing Show. I'm Clayton Morris. On today's show, on our live stream today, I wanted to take questions, talk about what's going on with this housing shortage that we're facing across the United States. I study these headlines every day, dive into the data, and what you'll notice, of course, we had massive lumber shortages just a short time ago. That has all moderated now. Lumber prices are back to where they normally are. But when you see all these stories in the mainstream media about inflation and the cost of things going up and cost of housing going up, remember, it all comes back to one simple thing: supply and demand. Just remember, when you hear all of these fake news media articles, or you hear conservative media trying to tell you that it's because of Biden's stimulus plan, you just need to ignore that, because that's absolutely not true. And when you hear Democrats saying this is because of Trump, because of what he did, that's simply not true. It's supply and demand. When you have a pandemic where people can't produce things, where people can't manufacture things or deliver things, and then when you also have on top of that a giant cargo ship that gets stuck in the Suez Canal, like that Austin Powers movie, where he keeps trying to turn around inside of a little tiny alleyway, you're going to have bottlenecks. And across the board, that's what we're seeing. When you have rental car companies that are selling off their entire fleet of rental cars, now they don't have any rental cars, and now suddenly people want to travel again. And guess what? Well, we sold off all of our rental cars last year, so now we don't have them. Chip components that are backlogged. You name it, across the board, there is a demand, but there's not enough supply. Food. In fact, I saw a summer camp story today where a summer camp had to be canceled because Cisco, the company that supplies the intermediary food for the summer camp, simply couldn't provide the food. So the parents, they had to shut the camp down. They just couldn't get the supply of food there. Supply, and demand. And right now, the housing demand is off the charts. Just look at this Wall Street Journal cover story. U.S. housing market needs 5.5 million more units, says a new report. I've seen estimates up to 20 million. 5 million, okay. But we have, I would say that's even being incredibly conservative. Construction on new homes in the last 2 decades lagged behind historical levels, contributing to a recent surge in home prices. Construction of new housing in the past 20 years fell to 5.5 million units short of long-term historical levels, according to a National Association of Realtors report, calling for a once-in-a-generation policy response. And so what will that policy response be? Well, right now we have an infrastructure package which is winding its way through Congress. Tomorrow, Chuck Schumer, the Senate Majority Leader, is calling for a floor vote, a procedural vote to actually move forward on infrastructure, a bipartisan infrastructure package. Will it include housing? We don't know what the final framework will be, if this will be included in this bill or the next bill. But there's going to be a big push for affordable housing across the country because there's an incredible demand for affordable housing. And if we dive into, the foundational understanding of the housing market right now, it's all about economics. In a normal housing market, when we look at supply from a realtor perspective, according to the National Association of Realtors, there should be about a 4 to 6 month supply of houses. That's what we want. That's the normal sort of equilibrium. 4 to 6 months is a healthy balance. Anything less than that is considered a shortage. Right now, we don't have 5 million properties because over the past number of years, builders simply hadn't been building affordable homes. They've been focusing mostly on luxury homes or those homes that were over $500,000. That's where the real money was for builders, where they could profit enormously by selling $1 million home and making it $300,000-$400,000 on the sale of that home. For them to build $100,000 homes, $150,000 homes, $200,000 homes, there just wasn't the demand. Frankly, because a lot of millennials were saying, we're fine to rent, we're going to live in a city, we're not going to buy a house, we're fine with that. Then the pandemic hit and everything changed. And millennials are saying, wait a second, why am I staying here in San Francisco paying a ridiculous rent? Now I don't need to work in this job in downtown San Francisco. I want to move out to the country. Same thing with Manhattan. People wanting to move out into the Hudson Valley and out into Pennsylvania where they could get a more affordable home. But guess what? There weren't any. So the existing home sales supply just plummeted because they were buying up whatever was existent. There was no new construction, so they just bought up older homes. The same thing is true of cars right now and used cars. Even if someone has a car with over 100,000 miles on it, that's a hot commodity right now. Even older cars, because we have no used cars. And if someone needs to buy one right now, guess what? They're settling for that car that has 100,000 miles on it. Ideally, you wouldn't want to buy a used car with that many miles on it, would you? Doesn't matter. We're in 2021. This is where we're at. Homes that are 20 years old, 30 years old, 40 years old, selling like hotcakes with no contingencies through realtors. And a report early this week, of course, that real estate is now seeing a 25% increase. It is the hottest housing market in the United States that we've ever seen. 25% increase in prices over last year. And what that means is that with this deficit, this includes, 2 million single-family homes, 1.1 million units in buildings, 2 to 4 units that we need are 2.4 million units in buildings of at least 5 units. The scale of this problem is massive right now. So where do we put investors? Where do investors fit into all of this? Because to me, this is a first time really comes down to sort of the retail play, first time home buyer. I want to buy a home. I'm a millennial. I'm moving out of the city. I don't want to work there anymore. I don't need that job. I want a better life for myself. But oh my God, I can't find a house. But where do investors fit into all of this? Well, the particular shortage was, of course, thanks to the pandemic. And everyone knows it's been harder to do business across the country. There have been supply chain issues across the board. And for us, I can say like at Morris Invest, one of the things that we were luckily able to do is lock in lumber prices at a preset level even before all the craziness. And because we build homes at scale, we're building 40, 50 homes at a particular time. We're building over 600 this year with our team, mostly in West Texas. We've acquired the land. We're in the best school districts. We're able to lock in those lumber prices, manufacturing prices all across the board, windows, et cetera, and materials. And so because of that, we're able to keep our prices in a very competitive and very advantageous position, which has been fantastic. So from an investor perspective, it's become increasingly difficult to find just single-family homes that someone's going to renovate. And it's made more sense for investors to begin to think about building new construction. Of course, the problem is, good luck finding contractors. Like if they're trying to do this on their own right now, they're just trying to go out and find, they've got raw land, they're trying to build on it. It's very difficult to do that. They're paying more for materials right now because they haven't purchased in bulk. So that's something they're going to contend with. And that supply bottleneck is going to continue for 6-8 months, could be upwards of a year in pricing. And of course, then people are overpaying for certain things. And so the benefit of being able to do things ahead of time and have the foresight to be able to lock in prices, to do things in bulk, and to plan ahead is incredibly powerful. The only way for prices to go down in this entire scenario is for inventory to go up. And really all eyes kind of on the infrastructure package right now. And what will happen when you have Democrats who are trying to push for low-income housing and affordable housing. And where they're trying to push for this, though, are in areas that have been depressed economically. So I have to tell you that that's not a place that I invest. I'm not investing in areas that have high crime, low jobs. And so what you're going to see the federal government attempt to do here is try to, and it may work. We know that when the federal government gets their hands in things, it tends not to. Now, if they can, in partnership with private businesses, actually build in areas of opportunity that actually are not going to be built with luxury. They did these opportunity zone projects, and then a lot of them ended up becoming luxury condos in opportunity zones, which some could argue, and we've had guests on our show arguing, well, that's actually great for that neighborhood. Really? Well, what about the people that have been totally priced out of that area that were living there and were hoping for an affordable place to live, and now they're pushed to the curb. They're out of there. And many people living in tent cities. I mean, just drive up and down. Try to go into San Francisco without seeing these tent cities that have popped up underneath overpasses right now. So we need inventory. And as you know, I mean, one of the most important components of making a solid investment, of course, is buying correctly, is buying right? We always talk about the profits are made on the purchase, not on the sale. It's on the purchase. So are you buying correctly? And are you positioning your investment? So I want you to just be aware of numbers right now. It's just a numbers game. Is your purchase going to be overpriced or just right? Are you paying too much? This is a very important question for you to be asking right now. And it's a very simple math formula to figure out. Are you paying too much? All you need to do is try to understand what your IRR is. What is your internal rate of return? Are you receiving a great internal rate of return? Or are you basically breaking even, or even, paying out of pocket to have this investment property right now? It's a very simple formula. I'm going to link it up here. We'll have, if you're watching this later, we'll have a link right here in the card to a video that I've done on internal rate of return, IRR. I want you to watch that video. We'll also link it up in the description below. It's a very simple formula for you to figure out, and I use real world examples of some of our new construction properties so you can see what the internal rate of return looks like. So if any of you have ever booked a call with our team and you're on the phone with one of our team members at Morris Invest, when you're going through numbers on a rental property and you're seeing if it fits for you and your family as an investment, all you need to do is look at the IRR. It's right there on the paper. You can see what the rent is because it's cash flowing. You can see what neighborhood it's in because it's in the best neighborhoods with the best school districts. So the tenants are going to stay a long time. They're not in depressed neighborhoods where the government is sort of shoehorning properties in there hoping to turn around a neighborhood. That's not what I invest in. If you want to be part of a government experiment, okay, you have more stomach for that than I do at this point in my investing journey. That's great that a neighborhood's going to turn. Call me when it does. For me, I want to be in the best school districts already, and I want to have a property that's going to be generating cash flow and income right now. But most importantly, in this incredible housing supply shortage, I want to make sure that I'm getting a return. We have incredibly low interest rates on mortgages. I mean, every day I write our newsletter, I see the interest rates, and I cannot believe it. Every day I'm putting a down arrow because they're under 3% for a 30-year fixed mortgage right now, on the backs of other people's money, on the bank's money right now. You can buy an investment property in this market with none of your own money, basically. You're getting like free money. I mean, your down payment, but then you're getting that back on your taxes. But you're literally using, as a hedge against inflation, you're creating almost like an infinite return for yourself using the bank's money right now as an investment. And then looking at that, okay, here's how much I'm paying for my mortgage. Here's how much the cash flow is. Here's what I'm getting back on my taxes as a form of a tax write-off. What is my overall internal rate of return? Figuring all of those things out, that should be your answer. It shouldn't be some arbitrary guess. But be cautious right now. I really want you to be cautious when you're investing. If the internal rate of return or the ROI doesn't make sense, like you're not doing charity work by just buying an investment property, hoping that it's going to go up, hoping that your cash flow position will improve, hoping that your internal rate of return will improve at some day. No, what is it right now? And then, yes, guess what? If you're buying it right now and you've got a great internal rate of return, guess what's going to happen? as things moderate and these prices come down, and there's an increase in inventory, guess what? Things are going to get better because now you've paid down your mortgage, your rent is still cash flowing every month. You now have growth in your portfolio. You've built equity. You can even pull equity out of that property, rinse and repeat buying another property. You can roll that into other investments. But right now where if prices are 25% higher, and I'm not saying that's the case with us, I'm saying like in general in the retail space, we're able to keep our prices very competitive in the market. And what we've had a lot of investors, and I think Nicole can speak to this in our chat, where we've had investors who've gone under contract to purchase one of our new construction properties like in June, and they're closing, and now the property's finished construction, the tenant is moving in, and then they close on the property officially, and it's appraised for way higher than they bought it or where they went under contract. Now, we don't adjust the price. That's just good on you. Now you've got a built-in equity position, like right out of the gate. That's what the market demands. That's what the prices are. That's what the increases in rent in the best neighborhoods. That's what we're seeing across the board. So if you have the means to build or get into new construction right now, great. I think that's a really solid way to make a difference. I mean, I'm super passionate about that. That's one of the reasons why we are doing that. We're building great affordable homes in fantastic school districts, where the demand is absolutely off the charts. I mean, we are building our goal for the year. We've literally had to double our goal for the year on builds because of the demand and the job growth, the influx of population. It's been phenomenal. And so, we want to be able to make a difference in a community, be able to provide a great place to live, have a great investment for our clients, and all of those things come together. It's really fantastic. But I just want you to be cautious right now. Like if you're going out there on your own trying to find properties and you're trying to massage the numbers, when you see these types of numbers, when you see an absolute, glut right now, or I'm sorry, not glut, the opposite. When you have an absolute dearth of properties right now, and there's an absolute shortage all across the country for rental homes, not even just rental homes, people for places to live. I'm talking, these are just places for people to live, like first-time home buyers who want a place to live right now. When we talk about actual rental units, that's a whole other story. And then get ready, of course, for a wave of evictions, a wave of people moving out of these homes because of unable to pay their rent, thanks to the pandemic. We have a backlog of that to deal with. So it's very important when you're reading these news headlines to understand, it's different for investors than it's going to be for first-time home buyers. It all comes down to you. It's going to come down to simply, what is the internal rate of return on your investment? Are you cash flowing with a nice position? Are you building up your equity position from having tenants paying down your mortgage? Are you building up a fantastic tax shelter? All of those things need to be factored in here. But if the numbers don't make sense, you cannot fake them. You can't massage them to make sense. And if you're also sitting on a property right now that many of you are saying, hey, should I sell this property? I get that question from a lot of you that say, I've got a property I've had for a number of years. I could probably sell it right now and make bank in this market. It's a rental property and it's only cash flowing this amount. I mean, that's a personal question. I'm not a financial advisor. You'd have to answer it yourself. But when you look at the overall market conditions, what is your internal rate of return on that property? Are you in the negative? Are you barely making it? Are you breaking even? And now you have an opportunity to sell that property, to take the equity, to take the profits and roll that into other investments right now that are actually going to have a great internal rate of return. Let us know. I mean, if you're interested in working with us at Morris Invest, we'd be happy to help you in that way with a 1031 exchange. So you don't pay taxes on that. Plus, you're able to roll it into an asset that has actually got a great internal rate of return and cash flowing immediately. Just go to our website at morrisinvest.com and book a call with us. And we'll jump on the phone with you for 30 minutes. It's very simple to do. And we can walk you through that process. Or maybe you've got an IRA that's just sitting there. You don't know how to tap into that. How can I use that as a down payment and then use this bank money right now to invest? there's multiple ways, of course, to crack that egg and to start to build actual cash flow. Because the way the markets are right now, I mean, look at Bitcoin today down in the 29,000 range right now, going down to 28. Volatility in the stock market, all concerns about this Delta variant and what's going to happen there. The Dow plunging 700 points. Runaway inflation right now. Also looking at the U.S. The Federal Reserve going to continue to print dollars, going to continue to support Wall Street. No signs of tapering just yet, so they're going to continue to buy and funnel $120 billion a month to prop up Wall Street for the foreseeable future. Fed Chief Jerome Powell last week said, "We'll give ample warning, but we're not doing anything now." So it's going to continue just the way it is right now, on and on. So what's a hedge against all of this? Real estate. Real estate, real estate, real estate. Just make sure, folks, you've got a really strong internal rate of return. And with that, book a call with our team, and I'll be happy to help you. With that, I'd love to open it up to some questions here. Any questions about the current market? Steven says, could you invest in poor neighborhoods to improve the place? Yes, but remember, just investing in a neighborhood, it depends on what investing you mean. Like if you're going to invest in building a new school, invest in building, multiple office buildings so that businesses will feel incentivized to come there, increase the tax base, build multiple single family homes to bring new properties in. A whole lot of things have to change. A whole lot of things have to change. A number of years ago, Chase Bank did an interesting thing during the Detroit fallout, during the last recession that we had. And what they did was they incentivized artists and small, like from Brooklyn. It was actually a pretty brilliant idea. They invited basically all of these small businesses and artists who would normally need like a warehouse space and a sink. That's really all they need to have their little studio. And they invited them and basically gave them opportunities in downtown Detroit, in certain like warehouses and so forth, to move their Brooklyn studios, or people who literally couldn't get a Brooklyn studio because they're so overpriced that people are having to move into Newark and they invited them basically come to downtown Detroit in this sort of opportunity zone. And Chase Bank, through subsidiary banks, basically sort of funneled that, supported that. It was a brilliant move by Jamie Dimon at the time, and helped really revitalize downtown Detroit, because what happened when these artists came, guess what? Then the artists want coffee. So then coffee shops opened. And they incentivized these like pockets, and all it took was like a small grouping of these businesses, and then the loft apartments above, and it just grew from there. And that's how you can create that was an effective way of creating change. But a lot of those things need to come together, and frankly, big money needs to be involved very often for that to happen. Ron95 says, hey, Clayton, my family and I went through it. We were renting the cost of the house to pre-take the house back, and we couldn't renew the lease. Apartments are expensive. Yeah. Teresa, downtown Detroit has revitalized. Is that the case? We were there about 2 years ago in downtown Detroit. Stayed at the Doubletree? I forget the name of whatever it is right above that really good seafood restaurant. Forget the name of that seafood restaurant. Really delicious there, right there in the one hotel right by the river. Sandy Koloski, Freestone, California. Yeah, now they're building luxury apartments everywhere. That's the thing. It's for a builder, if you're going to spend over a year and a half building, what are you going to do? Are you going to build single family units that you're going to make not as much profit on? Or are you going to build luxury condos where you'll know, or you have an idea that you're going to make a lot more money? That's the risk, right? And they took that risk in Brooklyn. They took that risk in Manhattan, and they had a lot of empty condos in New York City. And then when the pandemic hit, it really hit them hard because they overbuilt. They overbuilt in Brooklyn. It's what happened during the last recession in Miami. They overbuilt all these condos, assuming that they would sell. Then they turned them into apartments, and many of them were left vacant. And the same thing that happened in Las Vegas. Same thing in Phoenix. Steven says, I get wanting to get profit and buying in areas with high demand, but wouldn't it be better for the future to make areas that are not in high demand desirable? At scale, sure. But you think about what you could do, Steven, I get it. And sometimes what's the point? What's the point of trying to put lipstick on a pig? If an area just, look, you have these areas where you literally have lead pipes in the infrastructure. So regardless of what you do with a nice house revitalization, Stephen, you still have like infrastructure that underneath the ground that needs to be totally ripped out. And so what are you going to do? And so like in areas in like West Texas where we're building on untouched land, putting in all new sewer systems, like everything is brand new in the best school districts. And people are moving there. It's not like rich people. It's affordable homes. People going to university, Texas Tech, and people working in the hospitals, nurses and stuff. It's not like we're renting out to Jeff Bezos. But there's a lot of work that needs to be done in some of these older cities that have been left derelict. And so you can go in and think you're going to make a radical change by fixing one or two properties up, and that's great. But also you have to find those properties. So good luck finding like the houses that you're going to tear down or renovate. They're incredibly hard to find. Those that are available are being bought up, or they've already been renovated, or they're in the process of being, gathered up by a large hedge fund. So it's incredibly difficult. And a lot of times these hedge funds, unfortunately, they're not going in and doing massive renovations. They learned their lesson during 2008. They're buying up BlackRock and others. They're buying up as many of these derelict properties as they can. When people go into foreclosure, they're buying them up, and they're not doing much to them. They're putting lipstick on a pig, frankly. And so you're competing with that mess. It's a cost of updating versus a cost of creating from scratch. For us personally at Morris Invest, like you can't even compete with, if we're going to build 600 homes this year, and we're on pace for that this year, there's no way we could find 600 homes that would meet our criteria in the neighborhoods and school districts. That would literally mean like every home in a particular neighborhood was just vacant, just waiting for us to swoop in, like an old nuclear fallout town or something like that from the 1950s, She's not going to find it. So yes, we could cherry pick house here, house here, house here, house here. Incredibly time consuming and virtually impossible right now. You used to be able to do it. But at scale, you just can't do it. So it just makes sense for us. We're able to buy in bulk, build and buy raw land in the best school districts so that right when we're done, we have tenants already in demand because they want to go to the best schools. Just that's how it goes. Vince question says, using a self-directed IRA when purchasing an investment property, how important is it that you will not get the benefit of the depreciation of the property? How important is that? Vince, I would book a call with our team and speak with Haley on that question. It really is a matter of, well, what is your self-directed IRA doing for you now? And to be able to grow tax-free wealth inside of an investment vehicle where you get the benefits of tax-free cash flow, tax-free growth inside of a self-directed IRA. Now, yes, you don't get the tax benefits of depreciation inside of an IRA. That is one downside. But the upsides are tremendous. So, it really is a personal thing. And I think it'd be best too, if you had, depending on how much you have to work with, to talk with like our team members and see, what does that math look like? Like they can talk with you sort of on an individual basis. Thank you, Stephen. Teresa says in downtown Detroit, yeah, it wasn't a great thing for current residents. A loft was going in for $400,000 or haven't checked them lately. Yeah. Hey, they can try to sell them for as much as they want, right? $400,000 loft in downtown Detroit and that's the thing, the tax incentives had to be there. And so the city of Detroit also provided tax incentives for people to instead of being in the outlying areas, start to come inside the Detroit city or city. What am I trying to say here? Incorporated area where they would get tax benefits of actually living in Detroit. So that was we saw a migration pattern actually from people living in the exurbs outside of Detroit towards Detroit. Government working with private business. So, I don't know what the final number is on Detroit and how it's all come together. They still have, crime. They still have school problems. They still have a declining population. So that's not a place I would want to invest right now. Declining population, depressed wages. It's great that Ford is building an additional thing. They're taking over the train station. There's a lot that they're doing, but I'll wait till it turns around. Let's see. Efetobo says, I have a question. I'm thinking of CRE because of it has some upside than multifamily. CRE. Sorry, my brain's not working. Do you think of commercial real estate? Is that what you're saying? Commercial as in like business, warehouses and stuff like that? Is that what you mean by? Let's make sure I got your question right. Yes. Well, I don't know what you mean by more upside. Here's the thing. People will always need a place to live. And we saw during the pandemic that, guess what? Not everyone needs office space. And so it depends on what kind of commercial real estate you're talking about. I don't own any commercial real estate personally. I own all residential, and it's always performed for me. So I can't speak to that. I would say some of the areas that have the most upside right now for commercial real estate are warehouses, single story warehouse space for selling distribution of boxes. I mean, honestly, it's the last mile stuff. Not everything is distributed by Amazon, right? There's a lot of boxes delivered to your door companies that need warehouse space in last miles before they reach your home. So I'm not talking about the big distribution centers near big airports. I'm talking about the smaller warehouse spaces that are about a mile from your home, where things are staged and then sent to your house. So there is a demand for that. I do know that commercial real estate investors in the past 3 years had been tearing down sort of the multi-story office buildings in place of them putting single story warehouse space because there just wasn't a demand for another dentist or another law office. It was, we need people want to order stuff at home and get it shipped to them. But I literally know nothing about that sector. And, just to me, it's not something that I'm interested in. And certainly given the volatility right now, that's not something I'd be interested in. But single family, duplexes, always going to be in demand. And I can tell you, I know the data right now on the demand. And when you see that we've got a housing shortage and we need at least, according to the Wall Street Journal, 5.5 million units, and I've seen data up to 20 million units that we need in the United States to satisfy our housing shortage. So knowing that, why would I want to dabble my feet in commercial real estate when we've got a pandemic and we're seeing the trouble with, Delta variant, and we could be going back under lockdowns again in certain areas, and will people be going back home again? And so we won't be working in office spaces. To be investing in commercial real estate right now, especially if you don't know what you're doing and you've never done it, to me now is, in my humble opinion, to me is the worst time to get your feet wet and try to figure it out. at the very least, maybe be an apprentice to somebody who's doing it right now and ask if you can shadow them for a year to 2 years. But to me, this is not for the faint of heart right now. Benny Lynn says, what do I think of Gainesville and Huntsville? Gainesville, I know a little bit about. Huntsville is out of my purview. It's not an area I'm investing in right now. We're constantly analyzing markets, but Florida, we had been analyzing. We pulled back on Florida, and Alabama. We had analyzed. Alabama has a lot of upsides, but they also have a lot of downsides too, and particularly around jobs. So Alabama has what we look for in a market, of course, and there's going to be other markets across the country that we're not invested in. They're going to fit this criteria. Great jobs. I'm talking diversity of jobs, not a one-horse town where you just have one employer. Multiple jobs, universities, hospitals, tech, energy, you name it. All of those. So there's just an overall demand for jobs. And if one of them leaves, you have other sectors that are there. Crime, low crime, very low vacancy rate. We are in a housing shortage. You should not have a high vacancy rate right now. If you have a high vacancy rate, then there's something wrong with your town. I mean, right now, there should not be any houses available. If you do, then you've got an issue. Low crime. Again, low crime. And that's a problem in some of these areas. Obviously no jobs, high crime. And we also want to make sure we have great property management teams, great contractors. There's a whole bunch of things that fall into this. Also, is the state tax friendly, landlord friendly? We only invest in the most landlord friendly states. And I can tell you, Florida has a lot of problems with squatters. And it's very difficult for people to get tenants out of a property in Florida with squatters' rights. I know over the years I've interviewed people who own properties who literally people just broke into their house and started living in there. And the homeowner was like, I can't do anything about it. This person broke into my home and started living in the house in Florida. Squatters' rights. Yes, we do, Sherry, although we don't, we are right now. Book a call with us. We're not going to make a major announcement about it. But yes, we are in the process of doing that right now. So if you're interested in that, book a call with our team at morrisinvest.com. Also, I want to kind of go back to something that F. Tobo said about upside. Is more upside than multifamily. I'm curious what you mean by upside. Awesome, Sherry. Yeah, book a call with us. We'll tell you about what we've got going on in that area right now. You might be the first one to ask me that. Last question, if you don't mind. Is Chicago or the Chicago suburbs a good city to invest in? I can't speak to that. I really don't know. Again, I don't follow the commercial real estate space. I can tell you, though, from a commercial, Chicago is a hub. Chicago is a major hub. You've got FedEx. You've got a lot, you've got Indianapolis with a FedEx distribution hub. You've got Chicago as a hub. So outside of those airports where Amazon's building warehouses, you're going to compete with that and build warehouse space. Obviously there's probably going to be a demand to it, but I really can't speak to it. I don't follow that sector, Tobo. So I would say that's something I would really spend the time studying that, and I wouldn't just throw a dart at the dartboard and hope that you're going to make a good investment. I think this is really something you got to really, really, really educate yourself on before taking the plunge on it. Car Stan says, what shortage? So much is being built. Oh, brother. There's a massive shortage right now. Massive shortage. You might say there's so much being built right now. And that's true. There's a lot of cranes. There's a lot of building going on, of course. But when you think about if you just drive by a particular neighborhood and you see like 200 homes going up, okay, 200 single family homes going up, that is a drop in the freaking bucket. That is a drop in the bucket. When the Blackstone Investment Group builds a subdivision, they're building 200 homes, and we need 20 million. And by the time it takes them to actually build it, I mean, we have an absolute shortage, and it goes back 20 years. 20 years. 20 years it's taken us to get to this point, because builders have been focused on building luxury buildings or large single family homes. And you're seeing this massive sort of shift now. And now we need affordable homes. And these builders are under such incredible demand. They're saying, well, wait a minute, I can make more. I can make more for, building a large home rather than building smaller single families. So I'm going to put my money there, unless the government incentivizes these builders to do that. So they're going to be in this weird time for a while. I mean, it's just not enough builders to do it all. The commercial is weird right now. Hey, Don, good to see you. Don Elliott in the house. Carstan in the house. So, again, when we look at what's going on right now, 2 decades that we've lagged behind historical levels. And one of the big reasons we're seeing a surge in home prices. We knew this was coming, but the saving grace for a lot of these home builders and everybody, frankly, was that, millennials don't care about buying homes, right? So builders were saying, well, we're not going to build first-time homes. We're going to build the big ones that the 40 and 50-year-olds want to move into, now that they've got 3 kids. We want to build the big ones where we can get a big return on our investment of time. Luxury homes, larger homes, $500,000 homes, where the profit is for those guys. Because, guess what? Millennials aren't buying, right? They're just living in the cities. They don't care about buying a home. They're happy to rent. They're happy to backpack across Europe or the tiny house movement. And so millennials aren't buying. And then the pandemic hits. And millennials are like, I want to buy a house. Oh, crap, there are none. Because you know what? No one built them for us. No one built them for millennials. They were building them for the family of 5. So that's where we're at right now. And then on top of that, you have this incredible supply shortage just across the board, and you have a huge income inequality in the United States. So you have wages remaining stagnant or low at the lower end, and profit going up for the wealthy, and no in between. No middle class. And that's where we're at in the United States. It's a really, it's a crazy moment right now. James says, would your company concern shared investment with RE veteran entrepreneurs? Concern shared investment. I'm not sure I understand the question, James. Leah Lee. Should I take a 401k loan or do a Heloc? I'm thinking Heloc to pay off home mortgage. A 401k loan to buy a rental property. What do you think? Leah, I can't give you financial advice. I would tell you that I've done both. To me, a home equity line of credit was my favorite way of buying a rental property, because again, you cannot eat equity. So the home that you are in right now, you cannot eat that equity. Use that equity with this incredible run up in value. And if a bank is going to give you a line of credit on the house you're living in and you won't plan to move, use that credit to buy rental properties, in my opinion. But I hope you have read my book. I know Don Elliott did. Don is in the chat. Maybe he can give a shout out for it. But he and I talked the other day, and he said that this book, he read our book, How to Pay Off. And he lives in California, so he used our method, How to Pay Off Your Mortgage in 5 years. He paid it off in 2 years. I said, which is amazing. So this is my book, How to Pay Off Your Mortgage in 5 years. Hopefully, I think Kelly may be able to drop a link there. But you can use your home equity line of credit and to pay off your mortgage in record time, at the same time using it to invest in real estate. Sorry, I didn't put it up on the screen here. Don says, yeah, he paid off his mortgage 2 years after reading the book. That's awesome, man. I love that story. So you could use it both ways. And here's the book cover. I didn't have it on the screen. So you can use your home equity line of credit not just to pay off your mortgage, but you can use it, of course, to pay down, to buy rental properties. And then, yes, also your 401k. Like, again, that's just money sitting there doing nothing. So imagine borrowing from your 401k as a down payment on a rental property. Like if you work with us at Morris Invest, like a down payment on a rental property is going to be about $50,000 in that range. So imagine borrowing from your 401k, working with us, getting a down payment on a new construction rental property that's already cash flowing with a tenant in place in the best rental market in the country. One of the best rental markets in the country, cash flowing. So now you're paying back your 401k loan from payroll. You've got a home equity line of credit that you're using to not only pay off your mortgage, but also invest in real estate. And now you've built up your net worth. You've maybe picked up 2 or 3 rental properties in a short amount of time, all on the equity and cash that you have already. So Leah, book a call with our team. We'll look at this on paper for you. We'll help you out with this, figure out how this all comes together. And that's what our team is great at, is taking all of these different puzzle pieces for each person. There's no one size fits all. We love to try to work with each person differently. Yeah, Don says he used his 401k to buy a duplex. That's awesome. Consider partnering with our real estate veteran entrepreneurs. Sure, James. Yeah, absolutely. And the thing is, the reason that Natalie and I wrote the book is because we did it multiple times. So I love when people tell me that this doesn't work. Literally, what my best friend from childhood, Ben, growing up, one of my best friends from childhood, I hadn't spoken to him in a couple of years, and he invited me to go to March Madness. It was actually the Big East tournament at Madison Square Garden. I hadn't seen him in a few years. He had tickets, and we were catching up. And he's like, and he was an actuary, which I don't know. He got a perfect on his math SATs. Perfect. He's a math genius. He actually used to tutor me in math when we were in high school. He said, I read your book. And I was like, really? And he said, I have to tell you, he said, my girlfriend and I are 3 months away from now paying off our house, thanks to reading the book. And I have to tell you, I was floored. And then 3 months later, he texts me. He's like, we just paid off our house. He's like, I wouldn't have been able to do it without reading the book. I didn't even know that you could do this. And I was floored by it. Here he was, a perfect on his SATs in math. And he was reading my book on math, on how to pay off it was pretty funny. Anyway, you can do it. And you can use a Heloc to do it. You can use your 401k to invest. All of those tools are there. I'm telling you, just go through it. And we've got some free downloads and stuff in there as well. Sherry B says, yeah, we used our 401k to purchase 2 rentals. Worked great. And the interest you pay goes back to you. Yes, Sherry, that's another great point. Remember, you're borrowing from the bank of you, right? Your 401k is your money. And I'm not talking about withdrawing from your 401k where you're getting a penalty. I'm talking about a loan, borrowing from. You can do this. So for instance, I used Fidelity. That was my 401k provider back in the day. Go on to, I think it was my401k.com or whatever the website was for Fidelity. Log in. You could literally, there's a big take a loan button right there on your 401k. Click it or withdraw, but I clicked the loan. And you pick how much you want to loan to yourself. I picked the maximum, which I think was $50,000. And it was transferred to my bank account within 2 days. And that was it. Now I had $50,000 that was mine that I used to buy rental properties with. Then out of my payroll, it would pay it back, and you can pick the time limit, how you want to pay it back in 2 years, 3 years, 1 year, whatever. You're planning on being at your place of employment, then that's something you want to consider. I paid it back, I think, in 2 years or roughly. And that interest, because it's a loan, is being paid back to you. It's the bank of you. You are the interest. So you get to claim that interest. It's a triple whammy. It's really a fantastic, really fantastic way to go about it. Don says, I hear young people in Cali are using this method to house hack to live for free. Huh. Makes sense. Yeah, Car Stan says, can't wait to get my first property. It'd definitely be a multifamily. Yeah, I mean, look, to buy a duplex and to live in one side of it and to have the tenant and the other side of it paying for you to live, that's house hacking. I mean, and that's how you can build up, you're basically having them pay for your whole mortgage. And, they don't need to know that you're the landlord, right? Hire a property management company so you're not even involved in that process. Awesome, guys. Well, thank you guys for joining us on today's hour-long live stream. I really appreciate you hanging out, talking about this current state of affairs as it relates to the housing shortage across the United States, what that means for real estate investors. If you were late to join us and you're interested to go back to the beginning, we started about 10 minutes after the start of the show, so you can go just rewind, watch the replay. And we talk about some of the new data points out there, what's happening across the board in housing with inflation, supply and demand, all of that. So check out that. And hey, Clay, will you be incorporating live trading in one of your shows? Chickentron. I may on my other YouTube channel. I just had to see, I'm only one person. I can only do so much. So I'm trying to see if the time allows it. I might consider doing that on my Clayton Morris channel. It'll depend. So I'll see. I'll let you know if I do. But I am going to give that a try. I would like to do it because I'm doing it anyway. So it's just a matter of like logistics and figuring it all out. So thank you, everyone. Much love to all of you. Have a great rest of your evening, great rest of your week. Stay safe, everyone. And we'll see you back here next week at for our live stream next Tuesday. Same time, same bat channel.